All right, welcome to our explainer. Today we are really pulling back the curtain on the credit reporting industry. We're going to dive into the official rulebook, the one that dictates how your entire financial life gets boiled down into a single powerful report. Let's jump in.
So just stop and think about this for a second. You've got your car loan from one company, your mortgage from another, and a credit card from a totally different bank. They're all separate businesses, right? So how do they all manage to speak the exact same language when they report on you to the credit bureaus? Well, it's not by accident. It turns out there's a really structured and, frankly, a very serious system making it all happen.
And, when I say serious, I mean legally serious. As you can see here, before anyone even gets to look at this credit data, they are signing a binding contract. And they're not just agreeing to some simple guidelines. No. They're agreeing to follow a whole stack of local, state, and even international laws. And the legal stuff has some pretty surprising details. Get this, the liability for the industry association that actually provides this guide is capped at just $1,000. It's all provided as is, with no warranty. What that does is it makes it crystal clear that the real responsibility, all of it, for using this data correctly, falls squarely on the companies themselves.
This right here, this gets to the heart of it. Companies using this system have to indemnify, which is basically a legal way of saying they have to protect the industry association from any and all lawsuits. So, the big takeaway here is that this is a high-stakes, legally armored world. And how do you manage all that complexity? Well, you build a machine.
So, let's start by looking at the key players, the cogs and gears that make this whole machine run. It's really an entire ecosystem, all built around the flow of your financial data.
Okay, first up, we've got the data furnishers. This is ground zero. This is where it all begins. A furnisher is literally any company that reports your account information. We're talking banks, credit unions, auto lenders, you name it, even collection agencies. They are the source, the origin of all the raw data.
That raw data then gets sent over to the consumer reporting agencies, or CRAs, and you definitely know these names: Equifax, Experian, TransUnion, and Innovis. Think of them like the massive central libraries that collect and organize all this information into the credit report that you eventually see.
So who makes sure everybody is playing by the same rules and speaking the same language? Well, that's the CDIA, the Consumer Data Industry Association. They're the trade association that works with the CRAs to develop and maintain the standard format for everything. They are the ones who literally write the rules of the road.
So, what exactly are these rules of the road? Well, at their very core, they all boil down to two fundamental, legally required principles. Now, this is a super important distinction: accuracy versus integrity. Accuracy is what we all think of, right? Is the information correct? Is that the right balance? Is that my payment history? But integrity, that goes a step further. It means the information has to be verifiable. It has to be backed up by actual records. And it has to be reported in a way that actively tries to minimize errors. So it's not enough for it to just be right. It has to be provably right. And both are required by law.
And this quote, which comes directly from the guide itself, is so revealing. It really highlights the entire philosophy here. A credit report is meant to be a factual history. So if you pay off a collection account, it doesn't just vanish. No, it gets updated to show it was paid. The history, good or bad, is the history. The only time something can be deleted is if it was wrong from the start.
Okay, so how on earth do you enforce all of these rules across millions of accounts from thousands of different companies? Well, you create a universal language. And in the credit reporting world, that language is called the Metro 2 format. The way Metro 2 works is pretty clever. It uses different segments, which are kind of like standardized building blocks of information. You've got the base segment, which has all the core stuff: account number, balance, all that. But then you can stack other blocks on top to tell a more complete story. For instance, if a debt gets sold to a collection agency, a K1 segment is added to show who the original creditor was. This is huge because it prevents confusion and makes sure that history is tracked properly. It's a system designed to build a precise financial story, piece by piece.
But come on, life is messy, right? It's not always just on time or late. All sorts of complicated things happen. So the system needs a way to add that real-world context, and that's exactly where special codes come into play. Just take a look at a few of these. By using what are called special comment codes, a furnisher can add some really critical context. The code AH shows that an account was sold to a new owner. And look at AW. That code can note that a consumer was affected by a natural disaster. Now that is vital information for a future lender to have.
These little codes are what turn a simple line of data into a much more human story.
And here's a perfect example of how these rules all work together in the real world. When a debt is sold, there's a very clear three-step process. First, the seller closes their record and marks it as sold. Second, the new owner opens a brand new record. But this third step, this is the most critical part for consumers. The new owner is legally required to carry over the original date the account first went delinquent. This is a huge deal because it ensures that a negative mark doesn't stay on your report longer than the 7 years allowed by the law.
Now, let's be realistic. In a system this massive, with this much data flying around, mistakes are going to happen. It's inevitable. So what happens when the information is just plain wrong? Well, the law provides a really important safety net.
So what happens when the data on your report is just wrong? This is where a major piece of consumer protection law kicks in, the Fair Credit Reporting Act, or the FCRA. It lays out a very clear, mandatory process for getting errors fixed.
Here's the breakdown. First, you, the consumer, start a dispute with one of the credit reporting agencies. That CRA then has to notify the company that furnished the data, and that furnisher is now legally required to investigate. They have to review their records and report back what they find. And, this is key, if they find an error, they can't just fix it with the one CRA you contacted. They have a legal duty to correct that mistake with every single CRA they report to.
So let's just recap this whole thing. The entire credit reporting machine is built on standardization, using that universal language of Metro 2. It's governed by the legal principles of both accuracy and integrity. It uses this really detailed system of codes and segments to reflect messy, real-world situations. And finally, it has a legally required dispute process to act as the essential safety net. That is the machine in a nutshell.
We spent this whole time breaking down a complex system that's designed for one thing: accuracy. But it leaves us with a much bigger question, doesn't it? In a world that's now run by big data and AI, what does it really take to make sure that a credit report is not just accurate, but also fundamentally fair? That's a question that goes way beyond the rulebook, and it's one that the industry, regulators, and all of us will have to keep grappling with. Thanks for watching.